Welcome to Wealth Builders, the channel where we pull back the curtain on how the super rich build and sustain their fortunes. Today, we're taking a deep dive into one of the most powerful wealth building tools in existence, U.S. real estate. Have you ever looked at a skyline and wondered how those towering buildings translate into personal fortunes, or how a simple piece of land can become a legacy? Well, you're about to find out. Let's start with a mind-blowing statistic. A huge majority. We're talking about 80% of millionaires in the United States credit a significant portion of their wealth to real estate investments. In fact, real estate has created more millionaires than any other single industry. It's a tangible asset, something you can see and touch, and it has consistently proven its worth over decades. But here is the key takeaway. It is not just about buying a home to live in. The strategies employed by the wealthy are far more intricate and designed for one primary purpose: to generate and multiply wealth. They see property not just as a place to live, but as a dynamic financial engine. So what's the secret? What's the first play in the Millionaires' Real Estate Handbook? For many, it's a focus on one specific type of asset. Multifamily apartment buildings. Imagine this. Instead of buying a single-family home that might generate a small rental income, you acquire a building with 10, 20, or even 50 units. From the moment you close the deal, you're not just a property owner. You're the CEO of a cash flow business. These buildings often come with tenants already in place, leases signed, and rent checks rolling in. It's an instant revenue stream. Renowned real estate investor Grant Cardone is a huge advocate for this approach. His philosophy is simple. Why start a business from scratch when you can buy one that is already operating and profitable? He pushes investors to think bigger. He famously advises aiming for at least 16 units. Why that specific number? Because with 16 units, the rental income is typically substantial enough to hire a professional property manager. This is a gate. It frees you from the day-to-day headaches of being a landlord, things like leaky faucets and tenant complaints, and allows you to focus your time and energy on what really matters: finding the next great deal to expand your portfolio. You transition from being a manager to being an investor, a strategist, a true wealth builder. Now, let's talk about the magic ingredient that supercharges this entire process: leverage. This is a concept that truly separates the wealthy from the average investor. The rich rarely use their own money to buy properties outright. Instead, they use other people's money, primarily the banks, through debt. Let's break it down with an example. Say you have $200,000 in cash. You could buy one property worth $200,000. It's yours, free and clear. That's great. But your potential for growth is limited to that single asset. Now, let's see how a millionaire would use that same $200,000. Instead of buying one property, say you it as a 20% down payment to acquire 5 properties, each worth $200,000. That's a total portfolio value of $1 million, controlled with just $200,000 of their own capital. They've leveraged the bank's money to control 5 assets instead of one. Now, let's say the real estate market appreciates by 10%. The person who paid cash for one property sees their assets value increase by $20,000. But the leveraged investor, their total portfolio value has increased by 10% of $1 million, which is $100,000. Their initial $200,000 investment has generated a $100,000 return on paper. That is the incredible power of leverage. It's about amplifying your returns and scaling your empire at a speed you could never achieve. With cash alone, you're making the bank's money work for you. But direct ownership, even with leverage, isn't the only way millionaires play the real estate game. Smart investors know the importance of diversification. Putting all your eggs in one basket, even a very strong basket like multi-family apartments, can be risky. That's why they spread their investments across various real estate vehicles to minimize risk and capture different market opportunities. One of the most popular and accessible options is something called a real estate investment trust, or REIT. Think of a REIT as a mutual fund, but for property. When you buy a share in a REIT, you're buying a piece of a massive, professionally managed portfolio of income-producing real estate. These portfolios can include everything from sprawling shopping malls and high-rise office buildings to industrial warehouses and luxury hotels. The beauty of REITs is that they offer two major advantages: liquidity and diversification. Unlike owning a physical building, you can buy and sell shares of a REIT on the stock market just like any other stock, giving you easy access to your money, and you get instant diversification across different property types and geographical locations, something that would be incredibly expensive and time-consuming to achieve through direct ownership. It's a way to get exposure to the real estate market without the hassles of being a landlord. Beyond REITs, the options for diversification continue. There are real estate exchange-traded funds, or ETFs, and mutual funds. These investment products typically hold a basket of REITs and other real estate-related company stocks. They offer even broader market exposure, allowing you to invest in the entire real estate sector with a single transaction. It is the ultimate set-it-and-forget-it approach for passive investors who want a piece of the real estate pie. And for the more adventurous and well-capitalized investors, there's the world of private equity, real estate funds, and real estate crowdfunding. These platforms open up a whole new level of opportunity. Private equity funds pool money from accredited investors to acquire large-scale commercial properties or development projects deals that are typically far out of reach for individual investors. We're talking about developing a new luxury condo tower or redeveloping an entire city block. Crowdfunding platforms operate on a similar principle but make these types of deals more accessible, allowing smaller investors to pool their capital online to invest in specific properties. These avenues often come with higher potential returns, but also higher risk, and are a key part of a sophisticated millionaire's diversified real estate strategy. So, let's bring it all together. What have we learned today about how the wealthy build fortunes through real estate? It's not about luck. It's a deliberate, multifaceted strategy. First, they focus on assets that generate consistent cash flow, with multi-family apartment buildings being a prime example. They understand that income is the lifeblood of a healthy portfolio. Second, they mastered the art of leverage, using debt strategically to control more assets and amplify their returns far beyond what they could achieve with their own cash. Third, They don't stop at direct ownership. They build resilient portfolios by diversifying through a range of investment vehicles like REITs, ETFs, and private funds. This combination of cash flow, leverage, and diversification is the proven formula that has turned countless individuals into real estate millionaires. It's a blueprint for building not just wealth, but a lasting financial legacy. Thank you for joining us on Wealth Builders. We hope you found these insights valuable. If you want to continue learning the strategies of the world's most successful investors, make sure to like this video, subscribe to our channel, and hit that notification bell so you never miss an update. We'll see you in the next one.